Now I was saying make or buy decision. Make or buy a decision. Make or buy decision. Now, this is a decision where it is either you buy the product outside from a supplier, or you decide to make it within the organization. Now, when we talk about make or buy decision, these are the decisions which are available where a person might decide to make the product by himself or decide to buy the same product outside. Now, if the cost of buying is cheaper than making, then you can advise that person to buy. Now, if making the product is cheaper than buying, then you can advise that person to do what? To make. Now, let us say it. We say these decisions are formulated. These decisions are formulated in situation where the product can either be manufactured internally or produced externally. So these decisions are formulated in a situation. So these decisions are formulated. So we say these decisions are formulated in situation where the product can be manufactured internally, can be manufactured internally, or purchased externally from a supplier. Now, decision which involves whether to buy the product outside or to make it, or to make it, or to make it, or to make that product internally. And monetary factor to consider other than monetary. So apart from this factor, other monetary factor, other non-monetary factors to consider when making the product, when making or buying the product. Now, number one, what is one of those factors that consider? Now you can consider it's number one, behavior of the fixed cost. Behavior of the fixed cost. Now, if we decide to buy this product outside, now what is the behavior of the fixed cost? Now we shall we incur the same fixed cost? Now that's one. Now shall we or will we incur that cost, that fixed cost? Now we consider the behavior of that cost when we buy it outside or when we make it internally. Number two, effect of employee morale. Effect of employees morale. Now, when you decide to make a product internally, what will happen to the morale of the employee? Will they be motivated? Or when you decide to buy it outside? So that's another reason. Now, employee morale. Number next, alternative use of resource, which are idle. Alternative use of resource, which are idle. Alternative use of resource, which are idle. Now, these resources which are idle, can we use them to make that product? That's another factor. Now, if you have any other resource which are idle, now you have alternative resource, but they are idle, meaning you can spare those resources to either make an additional product. That's another factor to consider. If there is any alternative resource which are idle. Next, we can consider the value of the item. Now, the value of the product, of the item. That's the word item. Now, the item that you want to make or buy. Now, if you decide to make it, what will be the value of that product? And if you try to buy it from outside, will the value be the same? Now, you can consider the value before you make any decision whether to make it internally or to buy it from external supplier. Now, if I decide to make it by myself, will I be able to maintain the value of that product, or will it be best to buy it from the supplier where the value is maintained? That's another reason. The last one, the reliability of the external supplier. Now, reliability of external supplier. Can we depend on this supplier to supply for us the product whenever we need it? Now, if yes, then we can say to buy it from outside. If no, we can say to be making the product by ourselves. So how reliable is the supplier? So how reliable is the supplier? Now, let us do a question. Now, this question is adapted from AMA intermediate level. In advance, we don't have a lot of questions concerning this part, this other part. So mostly it is in the first part that we did, throughput and limiting, but you can find it in an exam because it's there in course outline. So we don't have to ignore it, because if you find it in an exam, then it is better we do it, because you can either find it or not. It can or it cannot be there. So in case you find it, then you shall not complain. Now, let us open our first paper for AMA. So I told you to make sure you have your AMA first paper. And we open this question. It's a very good question. November 2016. November 2016. Question number 3C. November 2016. Question number 3C. Umefika hapo? Let me also open mine. Kama nitaipata. I will say November 2016. November 2016. November, let me check. Yes. 2016, number 3C. Labua. The question is for Labua. The question is for Labua. The question is for Labua. Now, Network yangu ni kama imepotea. Yes, network yangu imepotea. Uko imepotea. Yes.
We can hear you clearly.
Na board, is it black?
It is okay.
Okay. Yes, resend awapate. Resend ama ni resend. Eme ama advance eme ama uko gani?
Amen.
Someone to send the management accounting past paper. Someone to send that past paper. formulated in situation of desperation. So these decisions are formulated in situation of desperation. In a situation where it is formulated in a situation of desperation. The lower price is known as the special price. The lower price, the lower price is known as the lower price is known as the offer price. It's known as the offer. The offer price is known as special price. No, it's as the special price. Known as the special price. A minute. So I will say that the lower price is known as the special price. It's known as the special price. Now, the concept is that the offer price should only be acceptable. The concept is that the offer price, the concept is that the offer price should be accepted. So the concept is that the offer price should be accepted. So the concept is that the offer, let us do the word offer. The concept is that the offer should be accepted. The concept is that the offer should be accepted if the offer price, if the offer price is equal or greater than the relevant cost. Is equal or greater than the relevant cost. You know what the relevant cost? Relevant cost. Now, in what case we talk about relevant cost, we talk about variable cost. Variable cost. Now, let us now move to our question. So tumesema that the lower price is known as the special price, and the lower price, this concept is that the offer should be accepted if the offer price is equal or greater than the relevant cost. Equal than the relevant cost. Let us go to our question. Let's go to our question. Now, we start now with the special price from that question. Okay. That question. Now, from this question, Reba Ltd manufactures the range of products. The companies absorbed the production overhead at a rate of 200 of direct wage. That's what we should start from. Now, the absorption. That one is very, very important. Now, we need to know how much is it absorbed. So how much are they absorbing? Now we are starting with the special offer. Letu malizie na make or buy. So we start with the special order. Letu malizie make or buy. Make or buy. Make or buy. Okay. Now I was saying we start with this question for November 2016. And our first part is make or buy decision. Make or buy decision. So we start with the first one. Make or buy decision. So make or buy decision. Now from our question, if we go to the upper part, after we start, wamesema that the overheads are absorbed at a rate of 200% of the direct wages. Now let's go to our question. Pale juu, we have been given this information. Fixed cost is 6,400. I hope everyone can see it. Pale juu tukianza. Then we have been given the variable cost as 96. When we add together, we are getting 16,000. I hope everyone can see that one very clearly. And I hope everyone can see that very clearly. Then you have been given direct labor. You have been given direct labor as 80,000. Now wanasema that this item is absorbed at the rate of how much? Both. So both fixed and variable. Remember those are production. Remember we talk about production. Remember when we talk about production, cost. We are talking about fixed cost used in production plus the variable cost used in production. Now, and from our table pale juu, if you go to our table pale juu tumepatiwa, it is clear that we have fixed cost for production. So we have fixed cost for production and we have the variable cost for production. Can you see it? Now, to our labor, yes, it is used for production, but let us ignore that one for now. Now, the two, which is the add, we are getting 9,600 plus 6,400, which are by total. Those are used in production. And then the question says that it is absorbed at a rate of 200 for the production. Let us see if it is correct. Now, what's our production cost? The upper. Let's see if it is 200%. So 16,000 over our labor. What's our labor? The question is 80,000 times 100%. Will you give us 200%? Will you give us 200% to confirm that it's absorbed at 200%? Yes. Now, let's see absorption. Absorption of fixed cost. Absorption of fixed cost. Mbona hii inaandika hivyo? Absorption of fixed cost. Najua haionekani, wacha nivute hiyo pen. It's not good. This way. Let us see the rate. So the rate of absorption of fixed production cost. Itakuwa ngapi? Itakuwa, what's our fixed cost from the question? Now the fixed production cost from the question, it is clear, it is 96. 9600 divided with the labor, which is 8,000, multiplied by 100. Unapata ngapi? How much is that? That one is around 120%. Then the rate of absorption of variable overhead. So our variable overhead is 6400 over 8,000 times 100%. We are getting 80%. Now we are interested with this rate. This is the rate which we are interested with. We are interested in this rate because this one forms the relevant cost. Forms the relevant. Because remember, when you talk about this concept of non-routine decision uses the concept of the relevant cost. Now let's see option 1 now. Option 1. Option 1. So let me read the option 1. Allow me to read. Option 1, it says a normal selling price of 20 while the production rate is as follows, we have been given. There is possibility of supplying the order of 2,000 units of the product at a cost of 160 Kenya shillings. The cost of 120 Kenya shillings. If the order is accepted, the no budgeted sales will be affected, and the company has the capacity to produce the additional units. Now let's go to requirement. Advise the management whether to accept the special order or not. To advise the company whether to accept the special order or not. Now, what did you say about this special order? What did you say about this special order? Tuko nazo hapo. Let us see. Let us see the cost, the relevant cost. We can start with the relevant cost. Relevant cost. Relevant cost. Tuanze na kwanza. We start with the material cost. Material cost. Now from our question, our material cost is 1. Where is it? Let's go back to the question. Material cost is 80. Material cost is 80. Is 80. Labor cost. Now labor cost from our question in ngapi? Labor cost from our question is 40. 40. Then we add the variable overhead. And we say it is the upper 80%. It is here. It is 80% of our labor. Our labor ni ngapi? The upper, our labor is 40. So 80% of 40 is 30. Is it 32? Yes. Is it 32? Yes.
Yeah. 32.
32. Now add them together so that we can get the total. variable cost. So inakuja ngapi?
150, 152.
Yes,
152.
152. Now, what's our offer price? The question. Offer price from the question.
160. 160.
160. Now, should we accept or reject the offer? Should we accept
Reject.
or accept the offer? Now, the concept is that the offer should only be accepted if the offer price is equal or greater than the relevant cost. Now, we can only accept when the offer price is equal or greater than the relevant cost. Remember, the relevant cost is our variable cost. Remember, the relevant cost is our variable cost. Now, should we accept or reject? Yes?
Reject.
Reject or accept? No, it's not reject.
Accept.
The offer price should only be accepted. Let me go and read that statement again. Kwa special price wanasema, the concept is that the offer should only be accepted if the offer price is equal or greater than the relevant cost. Now, our relevant cost is our variable cost, which is 152, and the offer price is 160. Now, we are saying that the offer price should only be accepted if it is more. Now, customer anasema tutengeneze na 160. Na sisi tukitengeneza tutatengeneza na 152. Now, tuchukue 152 kama our sales ama tuchukue 160 kama our sales? Now, if tutanunua na 160, if tutauza na 160, it is better, sivyo? Yes? Or what the question say? Turudi kwa swali. Huyu jamaa anatengenezea customer. Now, this person is the one supplying. So this company ndio ina supply this good to the customer. Now, should we sell at 160 or at 152?
160.
No, the offer price is greater than the variable or the relevant cost. So we need to accept the offer. So that one will say accept. This one is supposed to accept. Accept the offer since offer price is greater than relevant cost is greater than the relevant cost. That one is fine. Let us go to option number B. So tumesema offer price ni 160. Offer price from the question ametuambia ni 160. So we accept the offer because the offer price is more than the relevant cost. So we accept the offer because it's more than. Tunasema accept. Nadhani vile zaidi nyingine accept the offer. Because the offer price is more than the relevant cost. Either to buy or make decision. The other side, same question. Same question. Aha. Now we go to make or buy. Not. Wait. Together in a special. Right, together in a special order. Find a special order. So the other side when you make, we either make or buy. You either make or buy. You either make or buy. Make or buy. Make or buy. Hapo I think inaonekana make or buy. Now, let us go to our question. Now, wanasema part B, problem 2. The cost of making B, what is given below. So that's the cost. It wasn't a raw material. Cost of making. So relevant cost of making. So relevant cost of making. It wasn't a material cost. Naona wanasema ni 40. Material cost naona wanasema ni 40. Labor ni 80. Labor cost naona wanasema ni 80. Labor cost wanasema ni 80. Then we need variable overhead. We don't need the fixed. You only need the aspect of 80%. You don't need this one, 120. Remember, we said that for non-routine decision, we mostly deal with the variable cost. So we just need 80%. 80% of the 80. So it is 80% of the direct wage. Direct wage is our labor. Labor is the direct wage. So 80% of this 80. Which is ngapi? 64. Now find the total variable cost or the total relevant cost. Total variable cost. Someone else might call it total relevant cost. It is okay. Someone else might call it total relevant cost. It is okay. What is the total? Tunajua hapa ni 4. So 6 plus 4, 10. 184. Then buying. Cost of buying. Now, if we decide to buy, how much shall we pay? If we decide to buy, so that we compare. Now, if we should decide to buy, we shall buy it at 200. So, what do you think? Should we make or buy? Now, if we make it is cheaper, making is cheaper than buying. So, advice, the company should make the product since it is cheaper than buying. Since it is cheaper than buying. Since it is cheaper than buying. So they should make the product since it is cheaper than buying. I think that is all about it. Zilikuwa ngapi? All those decisions. Let me see. So the rest, I will not do them. But we shall meet for revision. Maybe for revision, or revision, we might be able to do the rest. So we are supposed to talk about the product mix decision, pricing decision, make or buy, and then you have this one. So go and find this note, and then you read on yourself. Drop. This is another decision of which sijaona swali yoyote, and I'm not going to do it. Retain decision. So in case you get a swali, I will tell you, but at the moment, hakuna. So drop or retain. Now this is where you drop any line of the business that is not making profit. For example, you have 3 lines producing good A, B, and C. Then you find that product A is making losses. Now you are doing three line of business. So you are producing product A, B, and C. Now A is making losses, B is making profit, C is making profit. Now you need to make a decision whether to drop this item which is making loss or not. Now you need to consider what if I drop this product? What will be the final profit at the end? Will the profit increase or decrease? Or will the profit will be more when this product is included in the product line? Now, these are those decisions. So these are the decisions which involve either to drop one line of business that is making loss or not. Let us just say it for you. But for a question, I will look for it, then we shall do it together. And that one will mark the end of the non-routine decision. That one will mark the end of non-routine decision. So we say these are the decisions which involves whether to drop or either to cease operation of business line which is making losses or not. So this is the decision which involves to cease the operation of business line which is making losses. Now, as a decision maker, you are required to make the decision whether we continue to produce this product which is making losses, or we drop it, or we cease to produce that product. So those are those decisions. We shall look for a question from our past paper about sijui kama kunayo. In advance maybe najua hakuna. In maybe we tafute uko kitambo. I think we can get one. But for in advance I have not encountered such a question. Now that one marks the end of non-routine decision, and that one marks the end of application of marginal costing for those doing MA. For those doing MA, for those who doing advanced MA, then we shall continue with the pricing decision. For those doing advanced MA, then there is need for us to continue with the pricing decision. Now, those doing MA, you can leave the class at your own if you want. So the rest we shall not find it in an exam. So the rest which I'm going to talk about, those doing MA, you shall not find it in an exam. But those doing advanced, we shall get them in an exam. So this is purposely the continuation now for advanced level. Now let's continue with the pricing decision. Let us continue with pricing decision for advanced MA now. This one is purely advanced MA. So the rest you can do. So let us now remain with those for advanced MA. We now do our items. Sawa.
Ibra,
Yes.
na ile yenye tuliandika replacement analysis, hii inaongelelea nini?
Hiyo iko kwa advanced FM. It was removed from the syllabus of MA. It is now in advanced FM. We shall do it in FM. So don't worry about it. So the rest, Jataja, you shall find them in FM. That one is replacement analysis. So it is there. Is replacement analysis and the topic which called capital budgeting decision. Capital budgeting decision. Now, but that one is okay. So that one, you shall find it in FM. You can read it in FM actually. You cannot find it in MA. That one was removed from MA. So at that point, mkwaje now? Up to that point, yes. Up that point mnasemaje? Inaeleweka ama inaendelea kuwa ngumu?
Tumeelewa.
Yes.
Understood.
Mko sawa? Kama mnaelewa the better. Kama mnaelewa, that is the better. Now, I want us, let me find that note for pricing decision so that we do kwa haraka haraka. Nitafute haraka haraka. So mkiniambia siku endesha the recording. So, but now we are saying the pricing decision. Pricing decision is a decision which involves setting prices, and you have said price is the amount of money that this customer is willing and able to accept to pay in exchange for a particular goods or service, or is the amount of money that the seller is willing and able to accept in order to exchange their product with another party. Now, pricing is very important, as I had mentioned, for survival purpose. So pricing is very important for survival. It's very important for survival. For survival of the farm. Now, the farm should not set a price where it will scare away customer. Where it will scare away customer. So they should set a price where it is competitive with the other company or it is attractive. So the price should be competitive and attractive. So the price should be competitive and attractive to customers. And attractive to customer. So you don't scare away customers. So you don't scare away customer. Factors to consider when making pricing decisions. Factor to consider when making pricing decision. Because of the 3 C's. The 3 C's. So now the 3 C's, number 1, we have the cost as the first C. Number 2, customers. Number 3, competition. Those are the 3 C's that we can talk about. That is the 3 C's that we can talk about. We can talk about when we talk about the customers, the factors which influence the pricing decision. When we talk about the factors which influence the pricing decision, the factors which influence pricing decision. That's one you can discuss them at your own time. You just go and find from the net how you explain these factors. You shall find them by mambo hiyo. These factors, you have customers. How do customers influence prices? Number 3, competition. How does competition influence? You kind of go and check how those factors affect pricing decision. Now, what I'm interested in is the method of setting prices. Method of setting prices. Methods of setting prices. Number one, break-even pricing method. Break-even pricing method. Break-even pricing method. Now, this is where you set prices equals to cost. So this involves setting prices equals to cost, meaning the price that you set, you are not interested with the profit. So the profit is zero. So you are setting the price at the minimum price where you are not receiving anything in return in order to beat the market. Once you beat the market, then you can now decide now to set the price above breakpoint. But in this method, you set the price within the break even. Now, involve setting prices. Involve setting prices to be equal to cost. To be equal to cost. So the first setting prices to be equal to cost. That one is correct. Then you say this method this method aims at just recovering the cost. So you are not interested about the profits. You are not interested about the profit. You are just interested about recovering your cost in order to beat the market. So the method aims at just the method aim at just recovering the cost and not making any profit. And not making any profit. Remember at the break-even point, profit is zero. So remember at break-even point, profit is same as zero. So this method aims at just recovering your cost and not making any profit. It is used when competition is stiff. It is used when competition is stiff. Competition is stiff. That's number one. One method of setting price. So you set a price at a point where there is no profit or loss. Now, in this case, you set the price where there is a lot of competition and you need just to recover your costs so that you can capture the market. Once you have the customer, then you can try to increase the price a bit. Number two, psychological pricing method. Pricing method. Now, this is mostly used in supermarket. So this method is mostly used in supermarket. Now, you can find that in the supermarket, they are saying that offer, wanakuambia hapo offer. Then wanakuambia it was 1,000. Now it is 799. Hapo wameweka hapo hiyo 1,000 wamecancel hivyo. Now, playing with the mind of a person. Now, you might find that this product, the exact price in a normal situation, that this price is 800. It is 800. Now, but because they want to play with the mind of this person who is buying, wanasema ni 1,000, then wana cancel. Wanasema it is 799. Now, remember, in a normal situation, you buy this item at 1,000, but they want to play with your mind. So what comes in your mind first, maybe if you are not keen enough, you say, wow, this price is 1,000. Today they are selling at 7.99. Now, but in reality, there is no offer. The only offer available is for 1 shilling because the product itself, it is 1,000. It is not, it is 800. But amekuandikia it's 7.99. But amekwambia offer. It was 1,000. Now it is 7.99. But in real sense, this price is 800. Now the only discount you are getting is 1 shilling. Now they are paying with the mind of the customer. Now, if you are new or if you are not keen enough, you shall be convinced that you shall get a discount or an offer of 300 shilling, which is a lie. So playing with the mind of the person who is selling, who is buying that product. So it is called the psychological pricing method. You try to play with the psychology of the customer. So you tell them you have it was 1,000, now it's 7.99. But the person selling knows that it is 800. So there's no offer, but they are trying to play with the mind. So the psychological pricing method, and we say, it's a pricing and marketing strategy. It is pricing and marketing strategy. It is pricing and marketing strategy based on the theory that certain prices have psychological impact. Have psychological impact. Have psychological impact. Next, number 3, penetration pricing method. Penetration pricing method. Penetration pricing method. And when we talk about penetration pricing method, it is where you set your price at the lower level as possible so that to penetrate in the market. So it involves setting prices at the lower level as possible so as to attract a customer. So we say involve setting prices at low level in order to penetrate the market. 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 It is also called skimming. It is also called the skimming pricing method. It's also called the skimming pricing method. Now, this is why the company set their prices at low level as possible in order to penetrate the market. You have another one method, skimming the cream. Skimming the cream. Skimming the cream. Let us see what is that. Skimming the cream. Skimming the cream. Skimming the cream ya maziwa ama inakuwa ya. Let us see. skimming the cream. Skimming. Tukija tukutana tutamalizia. Tuendelee. But hii topic lazima tumalize kesho. Imekuwa mrefu sana. Now, it involves setting prices at higher level. It involves setting prices at higher level. It involves setting prices at higher level, especially when the product is new. Especially when the product is new. So it involves setting higher level. So it involves setting prices at higher level. So involving setting prices at higher level. So involves setting prices at higher level. So involving setting prices at higher level, especially when the product is new. So especially when the product is new. As the time goes, they say, as the time goes, comma, price will reduce to normal price. Normal price. Now, that is what we call the skimming the cream. So it involves setting that the prices at a higher level. It involves setting prices at higher level. It involves setting prices at higher level, especially when the product is new. Another one, life cycle costing. Life cycle costing. We say it involves dividing the life of the business, dividing the life of the business into various cycles. I.e., we have the introduction, growth, maturity, and decline. Now that one I know you are doing it in leadership. So the life cycle of a company or the life cycle, those cycles. I know you have done them in your what? You have done them in your those who are doing leadership. I think you'll find something like that one. When you're talking about project evaluation, I think you'll talk about the life of a project or of a company. Those who did business management, you did the organization behavior, organization theory in your undergraduate. You also talk about life cycle costing in terms of the introduction, growth, maturity, and decline. Also, those who did undergraduate in business, when you are doing marketing, at some point you talked about this life cycle costing at some point. Now this look like in a living. If you want to draw it, so we can call it the life of that company. This side we can go with growth. Now, you start from the growth. Unakuja hivyo. Now, the initial stage is the introduction stage. Then we have the, we can talk about the growth. Kama inakaga hivyo. I don't know if this one is correct. Maturity, then the decline. Then the decline. This is the life cycle. This is the life cycle. Now, at each stage, so at each phase or at each stage, at each phase or stage, I'm gonna say each phase or stage, but I say each phase or stage has its own prices. Now the company will set different prices at different phases. So at the introduction stage, we shall have a price which is different from the growth stage, which is different from maturity stage, and which is different from the decline stage. So that's just an example of this one. Let's go to November 2015. Let's do this question for November 2015. November 2015. Question number 3. November 2015. Question number 3A. November 2015. Question number 3A. Question number 3A. So November 2015. Question number 3A. Question number 3A. So November 2015. Question number 3A. Now, someone to read for us. Someone to read for us. Yes. Tunasema November 2015 question number 3. Kipevu. I think it's Kipevu. Kipevu, yes. Now, ndo siongee. Ani? Umenyamaza sana siku hizi. Yes, Anne. We are waiting for you. Yes. Okay. Kama amekataa kusoma. Now, let me just read it. Let me just read the question because time is not on our side. Now, what the question says, Kipevu Ltd is considering launching a new product KV. The product is made to have the life of 3 years. So we have the life there. We have the product research and development, product design, operating costs year 1, 2, and 3, disposal costs. Then additional information. The company targeted revenue for the 3 years is as follows. The present value factors tumepatiwa, so no need to use the table. Tumepatiwa the table. Now determine number 1 required. Advise the management on whether the product will be launched. Now you need to advertise to advise this company if the product will be launched or not. So November 2015 was number 3A. November 2015, question number 3A. November 2015, question is number 3A. Now this question was not tested in the city or the other city. Kumaanisha you can find it in this sitting. So imekaa sana like 2 sitting or 3 sittings before ionekane. So meaning you might find it in the coming sitting. So you be very keen with this coming sitting. So you put a star on life cycle costing. You might find a question on life cycle costing in the next coming sitting. So you might find it was not there. Meaning, if you find it in the coming sitting, then you'll be ready. We are saying it is November 2015. Question number 3A. It is Kipevu. It is Kipevu. It is Kipevu. It is Kipevu. Okay. Now for us to advise, and remember we have been given some information. Now we need to know that with the information provided, we need to know that this concept is testing us the concept of NPV, which we did in our previous. So it is testing the concept of NPV, which I know you did it in the previous level. Now we know that NPV is equal to present value inflow minus present value outflow. So NPV, which is the net present value, we are saying net present value is equal to present value inflow minus present value outflow. Now, I think if we have managed to see that, now what is the life of this project? So life cycle, remember, we're talking about the growth. Now, what is the life? Now we have been told that the project will be there for how many years? 3 years. It will be there for 3 years. So allow me to come up with this table. Hapa iandike. Nataka kuandika Mora. Now, sio kubwa sana hii swali. Sio kubwa sana. So we need the details. Stock of year 1. Then you go to year 2. Stock of year 2. It is there for 3 years. Stock of year 3. Stock of year 3. Hiyo tunashikanisha na mkono hivyo. Aha. Not bad. Hivyo. Now that is how we should arrange it. Now the first thing we should start with. Now remember, for us to get the NPV, the first thing we need to do is to start with the revenue. Revenue. Now from our question, what is the value of the revenue? Aha. The revenue minimum is 900 for year 1. It is in thousand. So the question it is in thousand. So we have 900. We have 1800. Then we have 2400. Now we need to less our cost. So we less cost. How many costs do we have? The only cost that I can see, per June, operating cost for each year. Operating cost. Operating cost. Now we need to less the first one. We have operating cost for, we have 360. We have another cost here, which is for 20. For 20. And then 432. 432. 432. And then I'm going to cost of disposal at the end of year 3. Now, at the year 3, we shall dispose this item. At how much? Now, that cost of disposal, it will appear in which? Now, that one is a benefit. Now, I will show you how to do it. So, you have to now for now. We less. So, give me the answers. Now, we find the cash flows. Itakuwa ngapi? So, give me the cash flows. So what are the cash flows once we remove our cost? Well, how much for the first one? This one is 540. We have 1380. And we have 1968. We have 1968. Now, we need to find the total present value. Total present value. And we know that it goes to our cash flows. Cash flows, we multiply with the present value. The present value, interest factor for end period. This one is, so this one, in the bracket, present value, interest factor. So tofauti na hii. Tukumbuke tofauti na hii. Don't space it with this one. So this one and this one tofauti. Now we have been given these figures from the question. So for year 1, total year 1, itakuwa ni 5. So year 1 itakuwa ni 540. Multiply the present value. Hata wewe tuweke year 1 combine. Total present value, the present year 1 is 540. You multiply the present value of interest factor for year 1. So ni ngapi? Ni 0 points kwa swali ambaye 0.9100. Year 2 ni 1380 times tuende kwa table kwa swali wametupatia ni 0.8300 Then 1968 times 0.7500. Now give me the total. Give me the total present value. Is 30. Now it is 3112. Are you getting this figure? 3112. Now you take the present value, we raise the total present value, inflow, outflow. This is the total present value, which is our inflow. Now we raise our cost. So total initial outlay on our cost. Let's go to our question. If you go back to our question and tuambia, imepotea tena. Let me find it. Haya. Ilikuwa this one nimepata. Now our cost. You have the research and development cost. Tuanze na hiyo 1500. Research and development cost is one of our cost. Product design is our cost also. All these are in year one, so we are not doing anything to it. But we have another cost that was there at the end of year 3, which is 60. Now this one, we need to convert it to present value because all these two are in present. It is more than 0.7500. So you convert it to present value. What will be our total initial cost? So what will be our total initial cost from that one? Itakuwa 2145. 2145. Now our NPV itakuwa ni the total present value minus total initial outlay, which is the same as saying the present value inflow ndio hii, present value outflow ndio hii. So total present value minus total initial outlay, which is the same as 3112 minus 2155. What's our NPV? 976. 976. Now NPV is positive, so advice the products will be launched. The product should be launched. Since NPV is positive. So the product should be launched since NPV is positive. Since NPV is positive. September 2015, question number 5A. 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 Someone to read for us, Nikivutanga. Someone to read for us, Nikivutanga. September 2015, question number 5A. September 2015, question number 5A. Question number 5A. Question number 5A. Question number 5A. September 2015. Question number 5A. September 2015 question is question number 5A. Question number 5A. So September 2015. Nani anasoma? Ongeza sauti juu simsikii. The person who is reading it, the question. Subra jitoe tafadhali. Yes. Someone? Yani hakuna kabisa. Okay, ni sawa. Let me find it. Ndio. Where is it? So nimepata. So just let me read it. Because you have refused. You have refused to read. Now, let's see. Delcom Limited is planning to introduce a new product. The market research information suggests that the product should sell 100,000 units over the life cycle at a price of 420 per unit. The company seeks a markup of 40% of the product cost. The life cycle cost of the product is as follows. We have been given the life cycle. We have the design and development. We have marketing and distribution. Manufacturing cost per unit, we have direct material, direct labor, variable overhead, fixed production overhead. Then we have the end of life cost. Required life cycle cost per unit. Life cycle cost per unit. Now, we need to add all the costs together. Then we divide it by the total number of units. So we need to add all the costs together. Then we divide it by the total number of units. Now, in this case, we shall not consider the time value of money as the same as as we did in our previous question, because it is not a requirement. Unless you have been given, we have been told to find the NPV. Kama ujaambiwa mambo na NPV, then you ignore the time value of money. Now, let us start. Number 1, life cycle. Life cycle cost per unit. So we need to add all the costs together to divide the total number of units. Now, those are design and development. So design and development. Aya, tunasema ni ngapi? 10 million. Marketing and distribution. Marketing and the distribution, 5 million. 5 million. We also have manufacturing cost. That is per unit. Manufacturing cost. Now we have been given per unit, which is 200. You add them together. 50 plus 60 plus 60 plus 30. That will be equal to 200. And multiply with the total units. The total units is 100,000. This one will become 1, 2, 3, 4. 1, 2, 3. 20 million. Then we add them together. Now total cost. Now what's our total cost from that scenario? Add them together. So 2030 itakuwa ni 20 that. Do you have any other cost? Oh, we have one. Nimesahau moja. We have another one. End of life cost. Sasa moja tumewacha hapa. Umeona kuna moja end of life cost, which is 4 million. Then you add them together, total cost. So itakuwa ni 20, 30, 35 plus 4, which is 39 million. Aya, life cycle cost per unit. Life cycle cost per unit is the total cost divided with the number of units. Number of units was 100,000. Itakuwa, what will be the cost per unit? Itakuwa Kenya shillings 90 per unit. Number 2. Tumemaliza hivyo. Number 2 anatuambia, number 2 they are saying product cost gap. So this is the formula for product cost gap. Product cost gap. So the formula is equals to target actual cost minus target cost. Now we know how to find target cost. They find a question, but let us just give the formula. Now, target cost is market price minus desired profit minus desired profits. Let's find the target cost. Let's find the target cost. Now, the market price from the question, if you go back to our question, at the start up with you, wanasema the market price is for 20. The market price is for 20. We need to raise the desired profit. Now, the desired profit is the markup. Which one the markup is 40%. Now it is 40% of what? Of the market price. Now we need to convert this markup to margin. So how do we convert the markup to margin? Yes. So how do we convert markup to margin? Inakuanga hivi, percentage. So from markup to margin. Now our markup is 40%. What will be our margin? So this is how you convert it. Unachukua 40% divided with the total, which is 100%. But remember to add the 40. Itakupatia our margin. So how much is that? Mwenye calculate haraka. Mwenye calculate juu sina calculator. Yes, CJ. Unisaidia hapo haraka juu ya time. Yes. Ongeza sauti.
0.285.
So 0.285 times 420. So that margin inaenda na sales. Markup inaenda na cost. So hatuwezi tumia this one, atabatuna the cost. Hatuwezi enda na hii, inaenda na price. So 0.285 minus hiyo. So unapata ngapi? So what will be our target cost? What will be the target cost? Target cost Yes. Take the cost so that you can get the cost gap.
300.3.
Eh?
300.3.
300.
So 27 to 300. Now, let's find the cost gap. Cost gap is the actual cost, which is 390 minus 300, which is 90. That's our cost gap. Iko sawa? Kwa swali kwa amesema you find the cost gap. I think that one iko sawa hivyo. That one is the cost gap. That one is the cost gap. Number 3. The management accountant estimates that if the company spent additional 1,000 on design, the manufacturing cost per unit could be reduced. Compute the maximum manufacturing cost per unit that will be tolerated if the company was to earn the required markup. Which markup? The 40%. If the company was to earn the required markup. Now let us see. So you need to come up with a table. You need to come up with another table. Let's do it on this. Ama nivute hii. Allow me to do away with this one. Let me do away with this one. So that is part 3. Part 3. Part 3. Now let us see. So tunasema part 3. So wanatuambia instead of what they are trying to tell us is to compute the maximum manufacturing cost per unit that will be tolerated if they were to earn that profit markup. If they were to earn that profit markup. If they were to earn that profit markup. Let us start now. Tuanze. Start with the sales. Sales. Again for 20. You multiply with the number of units, which is 100,000. 100,000. Is equal to 420. 0, 0, 1, 2, 3. Which is 42. The less cost. Tunaanza na design and development. Now design and development ni ngapi? From question. Now wanasema if they could add 1 unit or 1 million to the design. So we had 10 million initially from our table, but wanasema wanataka kuongeza 1 million. Kumaanisha tutakuwa na ngapi? 11 million. Marketing and distribution, we know it is 5 million. Question. That one is not affected in any way. It is 5 million. Then we have end life cost. We have end life cost, which was 4 million. Now, what we don't know is the manufacturing cost. Manufacturing cost. Now they are saying, let us go back to our question. Let us go back to our question. So, tukiona basi kwa swali hilo wanatuambia, let us go back. Inasema, the management accountant estimates that if the company spend additional 1,000 on design, the manufacturing cost per unit could be reduced. Now, so initially, our manufacturing cost per unit ilikuwa ni 200. Now they believe it was 200 per unit, sivyo? Now they believe that if they increase the design by 1 million, this 200 will reduce, meaning we don't know the cost per unit. Cost per unit, we know the units ni ngapi? 100,000. But we don't know the cost per unit. But we don't know cost per unit. Let me call it CU, cost per unit. Meaning when we multiply 100 times cost per unit hapa, itakuwa ni 100,000 cost per unit. Hata niweke hivyo. Ama nitumie X. Let's cost per unit be X. Itakuwa ni times. Ama let it be Y. So we multiply by Y. Ikuwe rahisi. So that hapa itakuwa ni 1,000 Y. Which our Y is our cost per unit. Then niweke vizuri. Let cost per unit be Y. Now initially, we know it is 200 from the question. We know that the cost per unit for manufacturing is 200. But if we add, if we incur an extra of 1 million, this 200 it will reduce Y, which is a value lower than 200. Now we don't know that figure. Then what will be our target profit? Our target profit. Now our target profit itakuwa ngapi? Our target profit, let's go back to the question. Our target profit is it? Pale chini watuambia our target profit now the company is trying to make a markup of 40%. The company is trying to make a markup of 40%. Now, what will be our profits? What will be our profits? Or we use the, let me see. This one. Five, I calculate the target. The is a place where I calculate the desired profit. So give me that desired profit. Desired profit. Ilikuwa ngapi? Ulichukua 420 minus something. What was that? What was the figure? Ilikuwa 40 over 140 times 420. Ulikuwa pata ngapi? Hiyo ya 40. Ukisema 40 over 140 times 420.
120.
Ulikuwa pata ngapi?
120.
120. Now that's our desired profit. How many units do we have? 100. Now give me that figure. Then you find Y. Give me that figure. Then you find Y. So ni ngapi? Ini 120 00 123. That one inakaa hivyo. So ukishafika hiyo, that's the desired profit. Now find the value of Y. Find the value of Y, which must be less than 200. The value of Y, remember, is the Y, the cost per unit here, which must be less than 200. Which must be less than 200. Let's see. Now, 42 million minus 11 million minus 5 million minus 4 million. What is the figure? CJ, naona ndio umechangamka. 42 million minus 11 million minus 5 million minus 4 million. Unapata ngapi?
$22.
22 million. Plus minus 100,000 y is equals to 12 million. Tukizipeleka side ile itakuwa ni minus 100,000 y. Hii ikienda huko itakuwa ni 12 million minus 22 million. Itakuwa ni minus 100,000 y, which is equals to 12 minus 22. 12 minus 22, which is minus 100,000. 100 minus not 100 minus 10 million. So what will be the value of y? What will be the value of y?
100.
Now that is the new Kenya shillings cost per unit for manufacturing. Per unit for manufacturing. If for manufacturing if they had 1 million Kenya shillings of design of that point to sawa. We shall do more of the question tomorrow. So tomorrow we start from another pricing decision type, target costing, and at least we have an idea of target costing. Got a formula somewhere. So we meet tomorrow. We do target costing. Costing tomorrow. So tomorrow we shall finish pricing decision. Then we do another topic. So tukishamaliza topic, kwa baki topic 3. Tufanye kesho tumalize, then kesho kutwa tufanye moja, which ndio tutamaliza hiyo siku, hiyo ina issue. Then on Friday tumalize moja, then Saturday tumalize the last one. That is all about it for today. Let us meet tomorrow. We introduce target costing, we do some question, and we also look for other questions for life cycle costing. Now at that point, let us call it a day until tomorrow. So any question? Any question? Okay. So let us meet tomorrow. At the same time. Tomorrow from 7.